to participate in the 6th International Conference of the Academic Network for Latin America and the Caribbean, which will take part at the end of May of this year. No? Today, we are very happy to have Dr. Catherine Casanova with us. At the end, it was possible to have you on this very important topic. I remind you, Catherine Casanova is a senior economist in the Department of Financial Stability of the Swiss National Bank. She has worked also at BIS, at the Bank for International Settlement. She has a PhD at the University of Tübingen, among other things, and she has worked on lots of topics. But the topic that is of interest today is not the financial crisis, not necessarily Switzerland, unless she wants to talk about it. But the topic of our interest is the issue of Chinese the Chinese financial sector, the Chinese banking sector. She has been participating in a group of presentations, of publications on this issue, alone and also with Dr. Eugenio Ceruti, and we are very happy and pleased to have you here. Catherine, thank you very much for your time. As we agreed, you have something between 30 to 45 minutes, and then we will have some questions, mainly through the chat of Zoom. If you have problems, I would be very happy to support you regarding the questions. Yeah, so the floor is yours.
Well, thank you very much for this very nice introduction. So apologies for the delay. Our business laptops are blocked on Zoom, so I had to connect with my private one, and the connection did not work out. Yes, as far as it comes to questions, also please feel free to interrupt or send your questions in the chat, and then if you could read them out, that would be super helpful. And then I can reply to them on the go. Right, so our topic here is the global expansion of Chinese banks. So we can go to the next slide. That said, so the content and any messages that you can listen to today, this is of course our own opinion, and they should not be associated with any of the affiliated institutions. So the research question was about Chinese banks and their global expansion, and why did we actually focus on China and Chinese banks? Well, it's probably trivial for you as for this kind of audience, but well, China is the second largest economy, and it has the largest banking system in the world. And more recently, the cross-border lending has grown dramatically. And that means that for some emerging markets, China is the most important lender country. If you consider, let's say, the emerging market world as a market in itself, then China actually accounts for almost a quarter of that. And this is data as of 2021, and the trend was really on a growing basis. And especially during the most recent COVID period, there were a lot of discussions about indebtedness and relief for low-income countries. So that has also rendered this topic more relevant. On the next slide, you can find a comparison about the most important bank nationalities. So here we compare Chinese banks to Japanese, US, British, and also Swiss banks and French banks, because they are the largest overall. And you can see that Chinese banks, they lend to almost everybody globally. So there are some ties to all the different counterparties in the world. But what is very important here is that for 63 out of more than 140 emerging markets, they are the most important lenders. So these countries really depend on Chinese banks. Now on the next slide, you can see the characteristics, some of the characteristics of Chinese banks, and overall, they are pretty much like other banks from emerging markets, for instance, in terms of the government ownership, which is very pronounced, and also in terms of their business model. So some other, let's say, very important bank nationalities and individual global banks, they have very different business models in terms of diversification. They have more of, let's say, investment banking, or some of them have some wealth management. This is not something that Chinese banks actually focus on, not at all. For them, the traditional lending business is actually more important. However, if you compare them to other banks from advanced economies, they are similar in terms of leverage and in terms of profitability, and even in terms of funding structure. For instance, if you compare them to Japanese banks. So the bottom line here is, yes, they are different, but well, still there are some parallels. So on the next slide, this is very much what we find from the descriptive part, but also from our empirical analysis. So overall, the global footprint in terms of reach, which means that to how many countries do they actually lend, and where do they have foreign affiliates, they are very much, or they are relatively similar to other banks from advanced economies, or to, let's say, their peers from these nationalities. And then when it comes to the geographical distance, it seems that if you compare them to other banks from emerging markets, for them, distance is not that much of a barrier. I have to explain this already at this stage. So why do we look at distance? Well, in the trade literature, it's a proxy for information asymmetry, and that carries over also to international lending. So we use distance usually between two parties of, let's say, a contract, or here it's like the lender and the borrower, to find out about, is there a lot of information asymmetry potentially or not? And this is why this finding came actually as a surprise to us, because it seems like Chinese banks, they are even willing to make huge loans to borrowers which are far apart, and that does not apply to other banks from emerging markets. And now if we zoom into the Chinese banks, and not, sorry, can you go back? Okay, yeah. With respect to Chinese banks and their lending to other emerging markets, what is very important besides distance are other bilateral economic ties. That does actually not come as a surprise, but if you zoom into the details here, it is very, very striking in that other countries, so in the emerging market world, with which China has a lot of trade interaction, then that also means that we find a lot of cross-border lending. So trade is very, very important for Chinese banks in terms of, these are like the linkages that also exist in lending. They are very parallel. However, that does not apply to FDI, and that does not apply to portfolio or other kind of investment. You could expect that, but actually that probably comes back to some kind of portfolio restrictions on investment, but it does not apply to cross-border banking. So then already to the related literature, very, very briefly, we relate to the gravity models. This is what I mentioned in terms of the distance variable, because distance and size, they are dominant in this trade literature. And then also we relate to the literature on financial holdings and other, let's say, bilateral economic ties, which go beyond the traditional gravity literature. However, here our contributions are fourfold. So first of all, and this is very important, we take a binationality approach. This is not what you can traditionally see in the literature. Usually, especially when it comes to financial ties in the world, very often this is related to residence. So just to give you an example, Chinese banks, they have a global network. And that means that they could give a loan, for instance, to Egypt from the headquarters in China, but also from some other location, let's say somewhere in Europe, which would be closer. And that's why the difference between taking this nationality and residence perspective is very important, because otherwise you could not identify who is actually behind the loan. Just imagine they had a local representation, could be a subsidiary in London, and then the loan is extended from London to Egypt. We would miss that if we would take a residence approach, because then you would put all those banks lending from London together, and you could not identify who's actually behind it. And we would not know that these are Chinese banks. So taking this nationality approach is very important, and especially in the context of China here, as you will see. And then in order to, let's say, reflect this also in our approach, we need to have a new distance measure, because going back to my example from before, if you would take the distance between, let's say we know nationality, and we would know the distance between China and Egypt, it would be a different measure than if we know, well, it's a Chinese bank, but actually the loan was extended from London. That makes a huge difference. So when you have that kind of global network of affiliates, as Chinese banks have, you really need to have some adjustment to the traditional distance measures that are used in the literature. And then, as I pointed out, we relate this also to other economic ties. So the correlation with trade is really important. And this is where we can make an additional contribution, because we identify this besides the distance measure. And finally, well, there's not much evidence on Chinese banks' global lending. There are some papers by Reinhardt et al. and Horn, and there's a whole group working on it. But they actually use data from, let's say, public websites or contracts, but they do not have this kind of regulatory data that we actually have and that we can use. That said, the data itself is confidential, and that's why Swapan had done a terrific job actually to make it usable, so that we can extract the information without disclosing or without hitting any confidentiality issues here. So we can go to the next slides. In order to do this analysis, we use very different data sets. I will be very brief here. If you're interested, we are using data from the Bank of International Settlements. Basically, we proceed by bank nationality, as I explained. This is key. We merge other data on gravity variables. So gravity variables are like distance, which are traditionally used in the literature on trade. And then we also add data on trade and capital flows itself. So ultimately, we have a panel, and that captures 36 lending parent countries and more than 180 borrower countries. In that panel, we actually focus then on one cross-section only. You will see why that is very handy. And second, we will also have to restrict to some countries where we have data for all the different variables that we're using. So why do we need this new distance measure, and what could be an appropriate candidate here? There was a piece in BIS Quarterly in 2018 where we first addressed this question. And what was remarkable here was that if you now take, let's say, a very aggregate level, and now we only distinguish between banks from advanced economies and emerging markets, what we found was that when banks from advanced economies lend to any borrowers in advanced economies, only about 1/3 is extended from the headquarters. So just take the example of Chinese banks, only about 1/3 of their lending to a particular country from the emerging market world is extended from China itself. And the rest, well, that goes through offshore financial centers. So it's not extended from China itself, but it's extended by a Chinese bank from somewhere else. So could be an offshore center. And then also Yes, is there a question? Okay, no, then I'll continue. And the remaining third, that's dominated by offices in advanced economy. So that was also confirmed by an earlier piece, which found with very different data that about 40% of lending to emerging markets is extended from offshore centers. So this data is more recent, and now we'll zoom into the differences here. But just bear in mind that just because a Chinese bank is lending to someone, it does not mean that this is extended from China itself. Now, on the next slide, just to try to make this to illustrate the distance measure. So again, we take the example here of Chinese banks lending to Egypt. And what I will do later, but we'll first need this slide. Imagine there's a whole portfolio of loans given by Chinese banks to Egypt. And now we know that these loans, they can be extended from all over the world, including from China itself. But that's the trivia part. So we have the green arrow here, which says that there is some cross-border lending from China into Egypt. But then in this whole portfolio, there are more loans, and they could also be extended, let's say, from Brazil or Australia. So if we want to find a proxy for information asymmetry, which is usually assumed to, let's say, deter lending, we need to take all these different distances into account. So all the residences or all the locations where Chinese banks have a subsidiary or a local, just any kind of affiliate. So basically what we'll do in this distance measure, we sum across all the different arrows here, and we weight by the portfolio share of all loans extended by Chinese banks to Egypt. Now on the next slide, this becomes a bit more complicated because that's the formula which is behind this. I will not go into the details here because it would be too time consuming, but what we should bear in mind is that we take into account that a loan can be extended from all over the world, and we know the exact location, and we can actually make the difference here. And then there is one slight nuance here that I would like to stress, but don't worry about it too much, because it adds some more complexity. It could be that there's also that there is actually an office in Egypt. And that would mean that, well, that's super close. If you want to know your customer, you could also extend the loan to borrow in Egypt from, let's say, any affiliate that Chinese banks run there. And this is what we do with this, so you could call it a correction term, which is there to the right, which means that if there are so-called inter-office positions, we assign it a difference of just 1 kilometer to make sure that we do not distort our distance measure if there is such an office in the country of the borrower itself. But as I said before, a substantial share of Chinese banks' lendings does not only go, I mean, some part of a third goes, or roughly third or 40% goes is extended from the headquarters, but then there are many other affiliates that we are actually very interested in. So on the next slide, we visualize this, and just to give you some broad orientation here. So in the upper panel, we look at borrowers in advanced economies, and in the lower panel, we look at borrowers in emerging markets. And then on the horizontal axis, you can see all the different bank nationalities. To the left, you have the advanced economy bank nationalities like US banks. To the right, you have bank nationalities from emerging markets like China. And then we have these dots. So here, we just have two different kinds of borrowers, but we use a simple average. The basic message here is that, well, there is a global network of affiliates that Chinese banks maintain around the world, and that is really important. And you can see this from the difference, or from the distance here between the red dots and basically the yellow diamonds. If for some other bank nationalities, they completely overlap. And that means that, well, these bank nationalities apparently extend all their lending from the headquarters. Then there's a perfect overlap. But if there is some kind of affiliate which is closer to the borrowing country, then some bank nationality, and in this case Chinese banks, they would prefer to extend the loan from there instead of the headquarters. And then the final message here, in order not to make you to confuse you even more, is the subtle difference between the blue crosses and the yellow diamonds. And that basically means that there is some local presentation in that country. And just to zoom in even more, and maybe that helps to give you an example. So let's consider some countries in Eastern Europe. And here I highlighted Turkey, this as an example. Now, if you compare Chinese banks with US or Austrian banks, which actually are very important for lending to Eastern Europe, you can see that there are differences. The basic message here is that, well, Austrian banks, they just lend across border. So all the dots and crosses overlap. Chinese banks, they do not do that. They do lend from other affiliates somewhere else, which are closer, because there's a difference now in the dots. They don't perfectly overlap. But still, there's a difference between what Chinese banks do when they lend to Turkey and what US banks do when they lend to Turkey. Namely, that apparently Chinese banks have some kind of an affiliate in Turkey itself, because otherwise the yellow diamond and the blue cross would overlap. It's a bit, this is very complicated here, and I do not expect you to understand this directly, but just the takeaway message here for you is that, well, Chinese banks have a global network, and it's very important to take that into account, especially when we now proceed to the empirical analysis, because otherwise we would have a distorted distance measure. So if you remember the map from before, the message is that we need to take all the different arrows into account. So we need to know what exactly is extended from which locations abroad. Right, so now we can turn to the empirical analysis. If there are questions, unfortunately, I cannot read them. If you could directly raise the question, that's fine. Otherwise, you can postpone this to the
We
end.
will do it at the end, Catherine, and I will be happy to support you. Don't worry.
Okay, perfect. That's good. Great. Okay, so now we have seen some very complicated formulas, and there will be more, but I will try to make that, to simplify them for you. So in the first step now of the empirical analysis, we basically just have a cross-sectional approach. On the left-hand side, you can see the log of cross-border lending between a lender and the borrower country. So in our example, it would be like Chinese banks lending to Egypt, just to stay with this example. And then we regress this on a distance measure, and then we have other gravity variables, like, for instance, is there, for instance, a common language? Was it a colony before? And some other indicators of this, that's from the traditional literature. And then there's another, which is basically a vector of variables here. So the log of other economic ties. This is where trade and portfolio investment and FDI enters into the specification. And just to, let's say, absorb any constant effects from the side of the lender and the borrower, we use fixed effects. So for now, there's no interaction, a very, very simple model here. And on the next slide, you can see an illustration, just to explain again. So there are many lenders, there are many borrowers, but we just look at this from at one point in time. And then on the next slide, you can see the first set of results. So just to explain, in the first 6 columns, we look at all different borrower countries. And then in column number 7, we just look at borrower countries in advanced economies, and in 8 only in emerging markets. In column number 9, there are offshore borrowers. So basically, we were interested in what's the role of distance. Why? Well, because distance is a proxy for information asymmetry. And what we find is that, and this is for everybody, so for all bank nationalities in the sample, what we find is that distance plays a more important role when lending to emerging markets. And that's intuitive, right? In terms of, when this is all about credit risk. And if you think about it, credit risk is on average probably lower for borrowers in advanced economies. And that's why information asymmetry here has a different coefficient estimate. So that's the first message. The second message, and this is again at the very aggregate level, we're not distinguishing between any lender countries here, lending bank nationalities basically. Trade has a very strong correlation with international lending. So if there is a lot of trade going on between two countries, it's a fair guess that you assume that there's also a lot of cross-border lending between those two. And that is actually, this coefficient estimate is very similar across borrowers in advanced economies and emerging markets. So that's a very general pattern that we find for everybody. And you will see that it's even more pronounced for China. And then, sorry, could you go back? So yeah, basically, we do not find that for FDI or for other portfolio investment. It's only, it's weaker, let's say it in this way, but what really stands out is trade. So on the next slide, remember we had the red dots and the yellow diamonds. And the difference was that the yellow dots, they know about the global network of affiliates. And if we were just to use simple difference, a simple distance here, we run this, and what you can see is that, well, that would actually underestimate the distance effect. So we would get a distorted picture here. It's very important to use this new distance measure that takes into account that any lending between two countries, so a bank nationality in any borrower country, could be extended from a third country. That's the message here. Now, on the next slide, now, as I said, increasing levels of complexity, but just not to make it too difficult. Just think about this as we use the same specification from before, but now we zoom into different lender nationalities. So we highlight Chinese banks or US banks or banks from other emerging markets. That's what's shown in the specification. And on the next slide, we first do this only with distance. So we have a standalone variable for distance, and then we interact this for an indicator of whether or not the lender is, for instance, a Chinese bank or a US bank or some other of the major bank nationalities. And in this table to the left, you can see borrowers in advanced economies, and to the right, you can see borrowers in emerging markets. And the message from this table is that, well, for Chinese banks, distance, which was a proxy for information asymmetry, apparently matters less than for other banks from emerging markets. So they are more confident to lend to borrowers which are very far apart. And this is even when we control with the weighted distance measure for the fact that a loan could be extended from somewhere closer. So the loans here they don't have to be extended from the headquarters, so from China to Egypt, coming back to the example, but they could be extended from London or from Tunisia or some other country which is closer to Egypt. So that's the basic message for distance here. Now, that was the focus on distance in the specification, where we just interact distance with an indicator of bank nationality. In the next table, but this table is spread over several slides, that makes it also a bit complicated. We first of all show the standalone variables, and then later on we show the interactions of each of those with bank nationalities. So here you can again see the familiar pattern. When lending to emerging markets, we can see that there's a negative relationship with distance. So larger distances in general deter lending to countries which are further apart. There's a positive correlation with trade, and there's also some positive but weaker correlation with investment and FDI. And here the table shows for lending in all currencies, and then we distinguish by borrowers in advanced economies and emerging markets. And to the right, you can see the point that, well, if we isolate claims or lending in dollar, it makes some difference. And why is it important to look at dollar? I mean, now, let's say it's a side aspect for us here because it's there's a lot of complexity already. But in principle, a lot of trade is invoiced in dollar, and the dollar is still the key currency. And for Chinese banks, well, it's not their home country's currency, but still they extend a substantial share of their lending in dollars. So it makes sense to compare lending in all currencies with those of dollar, so those denominated in dollar, just to know about the relative importance of the currency. So that was the coming back. So what you can see here is, well, in this very complicated specification, the standalone variables still carry the expected signs for, let's say, the basic group. Now, on the next slide, we start interacting one of these variables. So here it's distance, weighted distance, WDist, with indicators of who is making the loan. And you can see to the left, for Chinese banks, only the baseline effect is there, but it's not, let's say, more pronounced. That's different, for instance, for US banks. But the basic message here is that, well, if you would compare this interaction effect, which stresses or highlights Chinese banks versus other banks, we find that apparently when they're pretty similar to other advanced economies like like Europe or Japan. And for the coefficient, the interaction coefficient here is not significant, but for other emerging market banks, it would actually be more negative, although not significant. Now, if you go to the next slide, this is the same exercise for trade. Again, you can see that there is this positive baseline, so the standalone correlation. And here, this is where we anchor the finding that for China, trade is very important. So what this means is that in general, trade patterns and lending patterns worldwide, they're very similar. But when it comes to Chinese banks, this is even more pronounced. So if there is a lot of trade going on between China and some other counterparty country, could be Brazil, could be South Africa, then it's very likely that Chinese banks make a lot of lending also to these counterparties. And this is much more pronounced than for any other bank nationality. And the pattern is even there when you isolate claims in US dollar. So this is one of the core findings of our paper. And now you can see where the empirical analysis actually shows this. Now, if we turn to other portfolio investments, as I said before, here we find a very atypical pattern for Chinese banks. So in principle, if there's a lot of portfolio investment, so if there's a lot of capital other than bank lending flowing into a country, the correlation with bank lending is not very high for Chinese banks. In general, it is, but not for Chinese banks. So that's atypical, and you could probably attribute this finding to some kind of capital controls. So money is not allowed to float freely between all the different countries. On the next slide, the same exercise for FDI. So in general, there is some kind of significant pattern, but it's relatively weak. For Chinese banks, there is nothing, because the positive standalone coefficient is completely cancelled or offset by the negative interaction coefficient for Chinese banks. So that's something which comes as a surprise as well. But overall, the bottom line is very, very important for Chinese banks are trade. So the patterns are even more pronounced for trade and bank lending, but not for any other kind of bilateral economic ties, like portfolio investment or FDI. Now, on the next slide, you could argue, well, China is special, and it is. That's really true. And China has launched some policy initiatives, and there are some very strong ties, other than pure economic ties or traditional economic ties, but you've certainly heard about the Belt and Road Initiative. So it's an initiative by the Chinese government, which dates back probably almost, I think, more than 5 years now, but not 10 years, where they wanted to actually make investments and have very close relations with other basically emerging markets, but it even goes into Europe. So the Belt and Road Initiative is an investment initiative by the Chinese government in other countries. And you could think that, well, maybe that's also correlated with cross-border lending. That's one initiative. And the other one is about central bank swap lines. So the PBOC, the People's Bank of China, which is the central bank of China, has swap lines with other countries. So they could basically make it easier to borrow in the respective local currency. And here what we do is, so we zoom into Chinese banks. We only look at Chinese banks and just run a very simple specification to find out about the correlation patterns here. So we still have trade and weighted distance in there. We still have portfolio investment in FDI, so that does not change. But then we add this indicator about whether or not the counterparty country is part of this initiative. So either the Belt and Road Initiative or the central bank swap lines. And what we find is, well, not much. It doesn't matter. For BRI, so the Belt and Road Initiative, it's insignificant. We only find a significant standalone effect here for the swap line. But still, as you can see, what's really striking here is a strong correlation with international trade. So again, if there's a lot of trade between two countries, or China and a counterparty country, there's a lot of lending by Chinese banks to these countries as well. Now, we're almost done. We have run some robustness checks, which are all listed on the next slides. I'll spare you from this because some of them are very technical. So we can come to the conclusions. So we find that in general, Chinese banks, they are huge, and they have a huge network of foreign affiliates. And in terms of their reach, they are similar to other banks from advanced economies. And when they lend to emerging markets, and that's very important from the perspective of the borrower country, we find that, well, Chinese banks, for them, apparently distance does not make much of it's not that important as it is for other banks from emerging markets. And the second finding, which really stands out, is this correlation with international trade. So if there's a lot of international trade between China and the counterparty country, there's also a lot of cross-border lending. Lending by Chinese banks can be cross-border, can also be from other locations abroad. But there's no such correlation for FDI, and even a negative correlation for portfolio investment. So what are the policy implications based on that? Well, recently depends on how you interpret this, but a couple of years ago, even before Corona, trade tensions started between the US and China, and there are more tensions ever since the Trump administration. Now it has changed a bit, but still, it's not the situation from before anymore. And so that could mean now, if you extrapolate the findings that we have, that this probably has also an impact on cross-border lending going forward. So that's something that we can show based on our data. but who knows how the situation will evolve now, also with the war in Ukraine. But in general, if there are trade tensions, you could assume that that also has a lasting impact on cross-border lending. Now, the second policy implication is that before COVID, there was a process of ongoing liberalization. And that was also let's say, when we started in 2018, the process was still ongoing. And when you extrapolate this, it could mean that, well, this negative relationship, which was very atypical, could change over time. Whether liberalization will continue or not, we don't really know. There was the COVID period, which has changed a lot. So basically, that's also a reason for why we do not take this into account. And there will be a follow-up paper on this. But initially, if there is, you could say that if liberalization was going to continue, then probably the correlation patterns of international bank lending and portfolio investment in China will be more similar to that to the rest of the world. So this was basically my presentation. Thank you very much for your attention, and now I'm looking forward to your questions.
Well, thank you very much, Catherine. Very interesting. I hope it is possible, Catherine, that you sent me your PDF PPT. Usually we upload them, and there is a lot of interest to see details and to follow it up. I hope it is possible, no, that you send it to us.
Sure. No, we can share the slides. That's great.
Look, we have already a couple of questions. Again, I will support you. Since I am the moderator, I have a couple of initial questions. You can react to them as you wish, and then we will get to each of the questions. No, a couple of questions. First, a very basic one. No, statistics, data, and sources. And particularly, again, remember, we work in different institutions on China from a Latin American perspective, and we have been doing our own data imaging statistics regarding Chinese investment in Latin America at the transaction level. And the difference is with a public Latin American and MOFCOM Chinese statistics are 10 to 15 times the national statistics, no? 10 to 15 times. Yeah. So, and sometimes the differences are by the sign, no? Plus whatever, minus whatever. And so based on this, you can come up with very different associations, correlations, and whatever. So based on a larger discussion, could you again briefly discuss this Bank for International Settlement, lending, borrowing statistics, and this matrix, if you want to, regarding the period, regarding some of the characteristics of this data set, how to get to these data sets, etc. I think it will be of a lot of interest, again, in many cases regarding China, Latin America, but not only, no? This would be one first question. Yep. A second question would refer, we have had, again, a couple of conferences regarding China, Latin America, and specific countries, financial and banking relations. No? A couple of months ago, we had Stephen Kaplan, who wrote a big book and analysis of 10 plus Latin American financial relations with China in his book Patient Capital, no? And he highlights that one of the main lending characteristics of China in Latin America, and here your opinion would be interesting, is that they have what he calls a commercial lending characteristic, which means they are not interested in structural adjustment programs, macroeconomic programs with political implications in some cases, but what they want is a clear warranty, commercial lending. No, this is I lend you so much and you pay me in oil. I lend you so much and you have iron ore. And we will see in the future which structure, the more Western structure or the Chinese structure, we will see in the next years, decades, centuries, I don't know, which one works out better. Would you agree with this general analysis, again, based on lots of case studies, including countries? Third issue. We've been working a lot regarding the property of Chinese firms, including the banking sector. In our opinion, it has been increasingly important to define with detail what is the public sector in China, which is not state-owned enterprises, no, because state-owned enterprises are less than 200 firms in China, which is a joke of the state-owned sector, but a sum of the central government, provinces, cities, and municipalities. And if you take this seriously, we have a couple of working papers on this. Around 85+% of China's banking sector is public. And this is an enormous characteristic, completely different to Switzerland, the United States, but also Mexico, Brazil, and any other country in the world. We don't put any adjective. We don't say good or bad, but we simply say, this makes it different, no? And finally, fourth question, again, you can take whatever you want of these questions. Very interesting, the correlations you come up with, as you might imagine. I have read some of them in detail in the papers you have written with Eugenio Ceruti, and I invite the audience to do so, regarding the strong correlation on trade for Chinese lending, less so regarding overseas foreign direct investment and portfolio investment. Here, two questions, additional questions. No? Here it would be interesting, probably less than investment or FDI, to associate or correlate it with infrastructure projects. In the work we have been doing, we distinguish between infrastructure and investment. They are completely different transactions, and here infrastructure and lending matters, I can assure you, or at least in the Latin American experience. And second, and again, this is a friendly fire and a friendly discussion, but why do you insist in trying to associate distance, no? However you measure it, distance with lending? If you say yourself, 1/3 of China's lending comes from China and 2/3 from other parts of the world, no? So at the end, probably geography matters a lot less than we would imagine. So I would start probably with the assessment. Geography does not matter very much. In the case of Latin America, you have Cayman Islands, Virgin Islands, and lots of different islands, which are the main spots for FDI, for lending, for whatever. And it is not Shanghai, not Shenzhen, not Beijing, etc. No, but just again, I don't know, I'm curious about this. So a couple of questions. We have 5 or 6 other questions. Take whatever you want to, and we could engage in responses with you, mainly with the persons who are participating. And again, thank you very much, Catherine. No?
Well, thank you very much for these super interesting questions. Let me work backward. So in terms of, well, trade, infrastructure, probably, yes. That sounds familiar, and that also relates to your other question about, let's say, commercial interest. And this is something we have not ourselves explored, but as I said, there's this paper by Carmen Reinhardt and co-authors, but they also have this some contract level data. But it very much, let's say, it complements our analysis. So if there's a commodity-rich country, Chinese lending is very strong. We find that for international trade, which captures international trade in commodities as well. So yes, that's completely, that points into the very same direction. About infrastructure projects, that relates to the BRI initiative, and there are other, I mean, it's the BRI meanwhile has grown a lot. When we did the analysis, we started with the first set of countries, and there it was not very strong, but in principle, I think the motivation is the same. You know, you want to have, or Chinese banks, they aim to have access to more commodities, and that's why they also support infrastructure projects. They lend locally, which would be reflected in funding an infrastructure project. So I think that perfectly aligns with your findings. About the distance measure, well, point well taken. And this is something where, I mean, the goods need to move physically from place A to place B, right? But the idea was here, you need some kind of proxy for information asymmetry. So the starting point is distance, and now take distance as geographical distance to start with. But now it becomes more complicated, because what we do not do is just to look at the distance between China and the borrower country, but we also look at the other locations, for instance, Cayman Islands, or for instance, other international hubs for banking, or maybe just there's a loan going to Peru, but it's extended from Brazil. So basically, with the data that we have this huge matrix, which is, we want to know about the nationality, and then we want to know about from where it is extended. So take it the other way around, distance matters, or let's say we need to know the location from where it is extended in order also to combine it with the information, where is the lender coming from. So if we would proceed by residence, we would have completely different conclusions, because you would see that, well, maybe there's a local branch in Brazil and there's a loan going to Peru, but then you would not know who is actually giving the loan. So distance for us has this kind of, it helps us to put an order to something and to identify from where it's coming from. And the distance is not, it's not distance per se. It sounds strange, I know. But the point here, it's probably about the location from where something is extended. So if Chinese banks only extend a third of their loans from the headquarters, there's a reason for this. Why? So could be taxes, could be capital controls, could be some other kind of reason. And that's where the map helps us, let's say it in this way. It's not distance in terms of kilometers, it's more like from where do they extend the loan and why. And this is something that we touched up on in this paper, and in the follow-up paper, we'll dig deeper into the characteristics of the location from where it is extended. But still, there's a lot of evidence also from other papers saying that it still matters, you know, in terms of how close you are to the borrower, because you know better about the local infrastructure. You're closer also, you know better about the creditworthiness of the borrower, and that's still difficult to do it from Beijing. So you need this kind of local affiliate abroad. But point well taken. Take it as we need to know the map, and we need to know the characteristics of the location from where the loan is extended. And then it still makes a difference of whether it's a Chinese bank or a US bank or a Japanese bank, as you said. Also because there is this difference in terms of their lending conditions. And that's also where, unfortunately, our data does not have any pricing information or information on the collateral, but this is also something that we are putting together different pieces from different papers here. There is, yes, apparently the conditions are very tough. So Chinese banks don't lend for free. There's collateralization, and the terms are very strict, also in terms of the interest rate. So it's not development finance. It's commercial, and that's, well, yes, that's the character. Unfortunately, we do not capture it in our analysis here, but that's kind of strange. Now, if you go back to your other question about who the features or the characteristics of Chinese banks, yes, the share of government ownership is very high. We came to this number because we look at the set of banks which report to the PBOC their cross-border lending. And I think you mentioned a number about 85%. That would also capture a lot of domestic banks, which are not in our sample because they do not give loans cross-border, so going out of China, or they don't run any foreign affiliates. But we completely agree that this feature of government ownership is very important. And now you have to bring this together with, well, still the conditions are very tight. And that's, well, it's, as I said, it's not development finance, it's a political interest probably. And as I said in a follow-up paper, we also want to look at this in terms of the characteristics of the borrower country. And apparently, I think it was in the Financial Times, and there was also a piece in The Economist on this, that given all this COVID uncertainty and turmoil, and some countries had a lot of difficulties, financial difficulties, Chinese banks continued lending to countries which have a lot of commodities because they are interested in them. And that speaks exactly to your point. And then I think something I did not capture yet, but which is very important, and Swapan will be the expert here, the data. So we are using the locational banking statistics. That's how the data set is called. And you can access a lot of the data. A lot of the data is free. And you can access it on the BIS website, so bis.org. It does not, there are several breakdowns which are available, but not all the data is available that we use is available, because part of it is confidential, but already, let's say the big picture you could still get from this data, and you can download it. Chinese banks became a reporting country in 2014-15. Swapan, jump in. I'm telling something wrong here because he's really the expert on this data set. And if you have questions, basically send them directly to Swapan because he's sitting at the source. He can answer them directly. But the data is very rich already, even if you don't have all the details that we're using. So if any student would like to work with this data set, it's not only about China, of course, it's about all the, I think we included 39 lender countries, and then you have this whole matrix with all the counterparty countries, let's say 180 plus borrower countries, and then there is a breakdown also by the type of lending. For instance, you can see for most countries, you can also see the sector. So is it the public sector? Is it the private sector to which these banks are lending? That's something we did not explore, but some additional dimension which is also available for most of these pairs of lending in borrower countries is the currency dimension. And that's also very important. I hope I captured most of them.
No, thank you very much, Catherine and Pradhan. I hope it is possible in the future to get in touch in very concrete terms, again, in terms of researchers and students interested in this topic, again, mainly focused on Latin America and the Caribbean, no? If it is okay with you.
Yes, no, I think there's a lot that you could already use from this data set, for sure.
But again, we can interact in terms of the experience of Latin America and China, no? A couple of questions. If it is okay with you, I have like 6, 7 questions, and I will go 2 by 2, and you take whatever you want to, so that we don't make this eternal.
No, of course.
A first question from Rafael in Mexico. He says that how easy is it for Chinese banks to lend to Mexican entrepreneurs, but it could be also Egyptian or Austrian, no? And are the interest rates from the are they more convenient than from other banks? This is the United States. One question, and the second question is, do Chinese banks distinguish between commercial and investment banking? What about insurance and other types of banking? I don't know if you have a reaction to these 2 questions.
So very briefly on the second question, I mean, there are some, especially Bank of China is one of the big players. Basically, there are 5 of them. There's some data which is published on their business model, and they basically, as I said, they have a very traditional business model. Basically, it's lending. They are not. They don't have a lot of investment banking or wealth management or some other kind of these. I mean, the traditional lending captures already a lot of commercial lending and then lending also to sovereigns. So that's the dominant part of their business model. In terms of the conditions, as I said, we can only see lending in terms of volumes and new lending, and then we can distinguish by the sector and the currency denomination. The complement here would really be probably the data that you, Peter, mentioned earlier, contract level data about the real conditions, or the paper by Carmen Reinhardt or Guido Horn et al. That we are citing. They have more information on the conditions, and I can only refer to them and what I learned from there, and also from the media like the Financial Times and The Economist, is that generally speaking, the conditions are tight, but of course, it also depends on what are the opportunity costs. So can you get a loan from someone else, and what are the conditions there? So in principle, I think that's what we can say on this, but we have limited information. We really have to refer to others.
Okay, look, Catherine, 2 additional questions. Again, take it or don't. From the first question, Andres Ruiz Furlong, a colleague here from Mexico, could Chinese banks be affected by the current crisis in the United States? And the second question, a more broader question regarding comparisons between some of the results you have been getting regarding China's lending and others' lending, the United States and others. No? So they ask, Jiang Li is asking, what's the pattern of subsidiaries for banks of other important nationalities? No? Do American or French banks also lend through their headquarters in Egypt to Egyptian projects? No, I mean, this is a huge question. Are there any results that you would like to highlight regarding China's lending vis-a-vis other countries? No.
Right. So with respect to the first question, I mean, we don't have any. There's no information on this in our paper, in our work, but basically just bear in mind that this is. The whole trouble in the US and the trouble that we have in Europe was caused by sudden rises in interest rates. And the exposure to these of Chinese banks is limited. Basically, for them, their domestic market and their domestic interest rate is probably very important, and that has not gone up by so much. So basically, I don't think that there could be a lot of there's no causal link, let's say it in this way. But this is just, as I said, my own opinion based on public information. The second question, yes, basically you can. I have shown you the dots, the dots and the red cross and the blue crosses and the yellow diamonds. From that, you can infer a lot about the answer to the question. Basically, what you can see there is that banks which are, let's say, periphery bank nationalities, for instance, Japanese and Australian banks, they have a lot of affiliates far away. So from this distance measure, you can see that on average, when lending to emerging markets, or on average, when lending to advanced economies, is there a global network of affiliates? And if so, where just approximately is it located? There is some kind of a first indication, as I said. So these bank nationalities seem to have a lot of the global network, which is very important, and they really tend to lend from locations which are closer to the borrower. So, for instance, Australian banks, if they lend to Egypt, they probably also choose an affiliate located in Europe, let's say it in this way. And some other patterns which are documented in our paper, for instance, is that Spanish banks in Latin America, I mean, this is probably even more about this than I do. Spanish banks are very present in Latin America, and so are US banks. So they have a lot of foreign affiliates, and for them, the business that they do in Latin America is really conducted from local foreign affiliates. So that's also something which is documented in the paper. And basically, if you're interested in this, you can read a lot about this from the graphs that we're showing there.
Okay, thank you very much, Catherine. Two last questions, and then we finish. You are getting late in Europe, so I understand.
All right.
Two broad general questions regarding your opinion by Alejandra Leon. No? She asks, so in your opinion, which are the benefits then or advantages of Chinese loans, and probably if we focus them for the emerging countries, as you have done in your presentation. And the second question is if you have an opinion regarding the evolution of cross-border lending from China, again, beyond associations and correlations where an evolutional perspective is more difficult. No, again, what are your insights on these issues?
So it's still growing. This is what you can see from I think it was on slide number 2. So they are still expanding, but what is the substance of our next paper is that they have become more selective. I think that's how you could put it. They, of course, they're also very about the credit worthiness of the counterparty, and they became more selective after COVID, but there could also be the reason of, let's say, sanctions and political tensions and, as I said, trade tensions. So on average, the aggregate number is still growing, but there are some nuances which we are going to explore here. And then the first question was again about the conditions, basically. If you take the perspective of the borrower country, a lot of, this is not in our paper, but was very well documented also by the media. For instance, I think there were several pieces in The Economist of this. There is, especially in the context of the Belt and Road Initiative, there is lending to local countries, but then there's the financing of, for instance, infrastructure projects. So you get all the expertise. It's not only positive for the borrower countries because Chinese banks are coming there, and then there are Chinese companies as well, which are building the bridges and the harbors and so on. So yes, it's positive in terms of infrastructures being built, but it's not everybody's benefiting from it because there are no local workers which are employed. So this is one aspect that you could consider, and then the question is, who else? Would there someone else who could actually make the loan? And especially for countries in Africa, well, there's development finance, but that's also tied to conditions, different kind of conditions though. But it's not, I think from the perspective of the borrower, it really depends on what, is there someone else who could actually make the loan and under which conditions? And for some of them, it's probably not that easy to get a loan. And there's a whole, this whole debate also now about lending, so IMF programs and World Bank programs, and whether there's debt relief, and China is very strict as far as that's concerned. So I think it's not an easy question to answer, but we have to take into account that also the world has changed since COVID, because debt levels have grown, and not all the countries are able actually to service their debt. And going forward, we'll see. But there's evidence that China became more selective.
Okay, thank you very much, Catherine. Thank you very much, Swapan Pradhan, also for your participation. Lots of food for thought, I can assure you. No, it will be interesting to interact in the future. Pradhan has been so kind to send us some initial links because, well, this is a big it has a lot of information, and we would like to exchange some experiences in Latin America. You have countries such as Mexico with a very dynamic relationship in trade with China, but practically no lending or borrowing, no? And you have other countries such as Venezuela, also very dynamic in terms of trade and very dynamic in terms of financing. So we might interact in the future if you can, no?
Yeah,
But
thanks.
again, thank you very much for your time. I don't know if you, Catherine, or if you want to maybe swap and Pradhan, if you want to say some final words before we finish, no?
Swapan, do you want to? Okay.
No, I think time is running out. So I think Catherine covered all the aspects. So I think there are needs for data which we understand. Catherine has mentioned. So there are 3 levels of data availability. One is the public data, which you can get through the BIS website, but that's more aggregated data. Bilateral data are limited, very limited. And those, it's not that we are preventing of sharing the data. It's the central bank who are reporting the data. They let us know which data we could share, which data we could publish, and that's all that we decide. So the reporting countries, they share majority of the data among themselves for their own analysis. But when we are in the BIS, we can make use of all the data with a joint project like I'm doing with Catherine, or as you know, with IMF. So for a analysis type like we in this paper, what we did, we need someone from the BIS. That level of granularity of the data is not available to anywhere outside the BIS.
But there's already something which is available on the website. So if you set it as a starting point, and then if you want to dig deeper, Swapan has some.
Yep.
There's something what could be made available, let's say, in this way, even if it's not a full matrix, right? Yeah. So, well, thank you very much again, and sorry for the delay. Technical problems, they still persist. And our laptops are super safe, and that's why, unfortunately, we cannot use them for Zoom. That's an issue. But no. But thank you very much, and I hope. Well, it was very interesting, very good questions. I'm really impressed, and well, let's stay in touch, and we are looking forward to any. If you have any more feedback, please let us know. Of course, that's.
Okay, we will let you know. We will upload the information, and we will be in touch by email. No, so thank you very much,
great.
Catherine, and Swapan Pradhan. Thank you very much.
Thank you very much for your interest.
No?
Thank you. Thank you.
Thank you.
Goodbye. Thank you.
Bye.
Bye.